Hello. Hang on. Hang on a second. I lost. What do I do to go live? What's that?
Yeah, I can see you live right now.
Okay. All right.
Yeah, you're good. Yeah,
Okay.
I'm watching it.
All right. Thank you.
Good. Bye.
Good morning. Good morning, everybody. This is Patrick MontesDeOca with the EMA2Trade.com live trading room here at the Equity Management Academy. Live streaming from the Equity Management Academy. We have a really choppy market here this morning. We got some economic news that came out regarding the unemployment numbers, and the market went into a sell-off, reverting pretty much from the weekly trigger that was activated at about 3:15 a.m. or even sooner, earlier, after the market came down below the daily average price of 1906 at about 10:30 p.m. It activated a bearish trend momentum. That target was the level below 1901, which was completed, and the weekly average of 1899 was completed. Now, the market at about 12:30 a.m. activated a bearish trigger at this level here that you see at about 12:30 a.m. On a close below 1899, it activated a bearish price trend momentum, thus activating the levels below of the buy 2 level and also the weekly level. So this signal here earlier, which came in actually on the Globex, it activated a daily and then a weekly short trigger. Now, this is during Globex, and there is an incredible amount of activity that's taken place during the Globex that for most traders that do not have access to that, it's going to be difficult to trade unless you prepare yourself with positions ahead of time in terms of the derivative markets that we use as well, and pretty much use them to create a or to, you might say, manage your risk synthetically. Now, one of the things that I keep telling you guys in my trading room, and I've been sort of preparing you, as you know, for this correction here, what you want to look at is how the market now behaves in this area that has been identified now, completing the targets, but we're in a blue zone. Okay, we're in a blue zone, and making a low of 1866.70, almost coming down to the weekly buy 2 level of 1859. So as you know, this is identifying for us the highest probability area where you should be buying into the market. If you've been waiting to buy into the market, cover your short positions, your short strategies, any hedges at all in this area. And I'm suggesting my traders in my live trading room to do the same. Now, you can use this strategy to cover pretty much any short strategies that you have. So let's take a look at the action in the market here and have a good idea in terms of what we need to do. So bear with me here. Let's just watch the market here a little bit. What you want to do here is you want to cover all the short strategies that you may have. We were expecting this reversion to unfold from a mathematical point of view, not a fundamental point of view. The VCPMI was anticipating this correction to come in into these levels here. We want to watch the behavior of the market. The market is going to confirm for us the accumulation that's taken place, whether the sellers here have capitulated and the buying here that should be coming in is going to be taking all of the supply offered at these levels. And so we want to watch the green bar continue to turn green, and every 15-minute bar to continue to turn higher. That's what we want to see. That's the confirmation that buyers are coming in or short covering is taking place. And this is the kind of confirmation that we want to see. I am covering short positions. Yeah, I'm looking to cover short positions. If you are short calls, if you are short the calls, you want to cover them at these levels here. We are getting a reversion to unfold from here, so continue to cover shorts and get long on the market. Get on the long side of the market. This is a great opportunity to cover any short strategies that you may have. We like these green bars, particularly these big, huge green bars. This is signifying, and as you can see, the market is extremely below the buy to level, and so the daily target when the market came down below 1891 went neutral. You no longer use the daily signals unless it comes above 1891 again, and that activates now the daily trigger. What we're looking at is activating the weekly trigger. It's in a weekly buy zone. This area in blue, particularly on the weekly, is telling us that this is the area where you want to cover any short strategies that you have. It really is very clear, transparent, and to the point that it's telling you this is an area of accumulation. And not only here that we're getting the daily to confirm now neutral. Basically, we don't use the daily at a close below 1891. It integrates itself with the weekly signals, and this is what it's called the variable changing price momentum indicator, that it changes from it changes from a excuse me for a second. I just got a text here. It integrates itself with the weekly, and that is what is called the variable changing price momentum indicator. That it has the ability to shift the AI now into what is called the harmonic relationship, and that's ideally what would be the highest, most probable area that we're looking at. And based on today's action, it would be a close above 1901. If the market rallies back above 1901 today, it would be basically confirming a harmonic alignment, an extremely strong signal, particularly after we experienced this sell-off, this expected correction that I believe is an incredible buying opportunity. We activated a buy trigger here, and pretty much momentum within this area of accumulation. Not really yet a trigger. I want to share with you the latest report that we published in the Associated Press this morning on Seeking Alpha, titled "Gold Ready for Takeoff, or Is It Another Big Flake Off?" This was published on June the 3rd at 6:22 a.m. Monetary, and it was written actually as of the close of yesterday. Summary: monetary policies also appear to be bullish for precious metals. The entire economy is now based on fiat money and debt. What we saw last March was the Fed opening up floodgates of easy money. Now, more and more cash is chasing a finite number of real assets, such as real estate, fine art, precious metals, and commodities. If you're looking for a portfolio of ideas like this one, members of Mean Reversion Trading get an exclusive access to our model portfolio by reaching out to seekingalpha.com. Fundamentals. Fundamentally, gold and silver have a bullish future. There are shortages in both sectors, which should drive prices higher. They are also attracting buyers with prices moving up in gold and silver. We recommend holding on to your long positions in precious metals. Monetary policies also appear to be bullish for precious metals. Gold is a flexible instrument and has been a currency for thousands of years. Fiat currencies such as the US dollar have been losing value since the US went off the gold standard in 1971. The entire economy is now based on fiat money and debt. The economy is sustained by debt provided by central banks. What we saw last March was the Fed's opening up the floodgates of easy money. Now, more and more cash is chasing a finite number of real assets such as real estate, fine art, precious metals, and commodities. After gold hit 1167, it shot up above 2089. On the basis of the Fed printing more and more money through stimulus packages. The Fed is creating money out of thin air, and in doing so, devaluing the US dollar as well, as the assets valued in that currency. Inflation is already here if you look at the commodities. Corn, wheat, and oil are all shooting up. But those increases are caused by the continuing devaluation of the dollar and more dollars chasing fewer real assets. Globally, central bankers have accelerated the amount of money that is coming into the system. We are looking for a potential situation like Japan in the 1980s, which went into a stagnant economy for more than 20 years. No matter how much stimulus the government provided, people did not spend money, and Japan was in a situation of stagflation for 2 decades. The Feds face a painful dilemma. They have to keep the economy going, provide stimulus, all while not raising interest rates. If they raise interest rates, when the massive amount of debt, with this massive amount of debt, will lead to defaults rippling across the world. The problem is that with interest rates already so low, the Feds don't have any options to influence the economy. If interest rates rise even a tiny bit, the cost of that debt will explode and defaults will mount quickly with every percentage increase in interest rates. Even a 3 or 4% increase will devastate the global economy and will be unsustainable. With fiat currencies losing value, virtual currencies have gained a great deal of attention. Bitcoin and Coinbase and others are gaining a great deal of interest. We trade GBTC, the Grayscale Bitcoin Investment Trust, as a proxy for Bitcoin. It is regulated unlike Bitcoin, so we are more comfortable with the trust rather than Bitcoin itself. We may be entering a period like the 1970s with inflation hitting double digits, 14%, and gold rising fast. Today, commodities are rising in price, and we could be seeing a major move up in all commodities. Some argue that we are about to enter a period of explosive growth. Of explosive economic growth, and we believe such statements are overblown. We are seeing some economic growth, but it is based on fiat money and the printing of fiat money. It is not real economic growth. It does not appear that such a system can last long. Since it is not based on real economic factors, the government can't continue to support everyone and everything indefinitely. It seems that we will see a spike in interest rates. In order for the Fed to bring down interest rates in the future, they will have to allow inflation to rise now and interest rates to also rise. Then the Fed will have the ability to lower interest rates from those new higher levels. To control interest rates, the Fed will allow short-term rates to rise while capping long-term rates on the 30-year bond. Long-term rates cannot go up or dominoes will fall and we will be in a catastrophe. The economy is still fragile, and it is possible getting worse as the debt increases. Over the next few weeks, we face the prospects of more inflation, interest rates rising, and where the US dollar is heading. And we are beginning to see a premium in the gold and silver markets as well as in virtual currencies because of the fear that the US dollar will decline even further. When such fears exist, people run to hard assets like real estate and precious metals. This is not temporary. Real estate is not going to come down anytime soon unless we begin to hear the language changing from the government in terms of interest rates. In the meantime, stay long precious metals. As we wrote this report, gold was trading at 1905.60. It was about 70. It was all over the place. Silver was trading at about 28.04. And we have been testing at this level the variable changing price momentum indicator. The average price for the week was 18.99. The VCPMI daily average for today was 19.05. And since last night, gold has traded towards the weekly average of 18.99. By trading below the daily average, it activates a bearish trend momentum. When it activated a bullish weekly trend momentum, which negated the daily bearish trend momentum, now is as a daily, weekly bullish trend momentum. This is what I was referring to a bit before, that the market on the daily coming down has integrated the weekly numbers. And so now we have a weekly and a daily bearish trend momentum. Silver has penetrated the VCPMI. Weekly average price, and by trading above it, it has activated the weekly bullish trend momentum. The initial target was 28.21, which was completed, which is the daily average price. If we close above that, then we will have a daily and weekly bullish trend momentum. Right now we're neutral unless the silver closes about 28.21. By trading below the average prices in gold and silver, there is a 50-50 chance of the markets going up or down. So we want to see the market reach the extremes above or below the average, which provide much higher probability trades. We appear to be breaking out on an upward channel that started around 1673. The weekly target range is 1939 for the rest of the week. This target's potentially could be completed, which could match the sell-to level daily of 1930. We are entering the VCPMI identifies as a high probability area where supply should come into the market. And that's pretty much what we experience here, as you can see. But also we completed the weekly target of 27.21, and it has activated a buy trigger on the weekly from B1 and buy 2. This is the most incredible volatility that I keep saying to expect as we unfold this levels, you might say, of accumulation, testing the strength underneath the market. And as you can see, the algorithm identifies these areas with extreme accuracy. And depending upon your ability as a self-directed trader to take this intelligence and apply it in your trading will pretty much give you the opportunity to take a look at the market from a mathematical point of view. This is a probability mathematical model. It is not a fundamental model, but it is more accurate than the fundamental model. Just to point things in case, we had, if you take a look at the internet, massive sentiment, bullish sentiment, calling for some outrageous numbers in the precious metals. And that is the reason why my report was titled, is it a breakout or is it a gold flake? And obviously it was a gold flake, but it's a reversion unfolding that gave you, the trader, the contrarian trader, okay, that are following the sentiment completely the opposite, to now come into the market and enter on the net long side of the market, which is where you should be long term. Use any of these corrections to get on the long side. If you think you've missed the market, you pretty much haven't missed anything, because the market is giving you the opportunity to do that as we speak. So what we want to see, once again, is a reversion to unfold from these levels, which will give you the mathematical probability where you essentially have the odds on your side by going into the market on the long side when the VCPMI identifies these extremes. Right now, the market is identifying the extreme below the mean, and not only on the daily, but it's integrating the weekly signals as well, which is the harmonic relationship at these blue levels, which essentially, using conventional technical analysis, represent support or extremely oversold conditions. Thank you once again for the opportunity to share this with you live right here in the Equity Management Academy live trading room. And please subscribe to my channel, Join us. This is something that will change the way you look at the market from a technical point of view. This is Patrick MontesDeOca. I'll talk to you soon. Have a great day, guys. I'll talk to you in the room. Take care.